These are the lessons: market time frame, pip, broker, spread, lot size, leverage, margins, trading sessions, types of trading, types of traders, time frame for different traders, market orders. Market time frame. Market time frame can range from 1 minute to 1 month. Market time frame is a time period in which a candlestick opens and price tends to move up or down within the time period. Once the time elapses, the candlestick closes and a new candle is formed. You can see here we have 1 minute, which is represented by a symbol of M1. We have 5 minutes M5, 15 minutes M15, 30 minutes M30, 1 hour H1, 4 hours H4, 1 day 1D, 1 week W, 1 month MN. We represent each time frame with this symbol. So on your phone, you can go ahead and download MT4 or MT5 on your phone. You will see all this time frame on your chart. Time frame helps to observe trends and also to know the opening and closing time of the market and its price movements. PIP, point in percentage. The full meaning of PIP is point in percentage. So PIP means point in percentage. PIP is the distance of the price move of the market price, and it is used to measure the movement of the market. PIP is the 4th unit number after the decimal point, which is the smallest unit of an exchange value. So looking at this, we have Euro USD, and Euro USD price as at now is 1.1051. So the 4th number after this decimal point, this is 1, 2, 3, 4. So this 4th number after this decimal point is called PIP. Or you can say the 5th number is called PIP. It's either you say the 5th number is called PIP, or you say the 4th number after the decimal is called PIP. You can see Euro USD 1.1645. The 4th number after this decimal point, 1, 2, 3, 4 is called PIP, or the 5th number is called PIP. USD JPY. This is different from Euro USD, so I do prefer to say the PIP is the 5th number. 1, 2, 3, 4, 5 is the 5th number. In the above picture, 1 is the PIP because it's the 4th unit number after the decimal point and it represents 1 PIP. So broker. A broker are the middlemen between the forex market and the traders. Traders comprises of the buyers of a particular currency and sellers of another currency. Brokers made the trading platform available for traders, which are the buyers and sellers of currencies in the forex market. Looking at this picture, you can see we have a buyer, which is this man holding his bag of money. Then we have a broker, which is like an agent. Then we have a seller, which is this woman. What is this woman selling? The woman wants to sell a yacht. Why the buyer wants to buy this? So this broker is the agent. This lady is the middle person between this buyer and the seller. This is what they want to transact. So the seller goes to the yacht broker who searches for a buyer. The buyer purchases the yacht from the seller pays the broker a commission. After transacting, this broker gets a commission for that particular transaction. Brokers are the middlemen between the forex market and the traders, while traders comprises of buyers of a particular currency and sellers of another currency. Brokers made the trading platform available for buyers and sellers of currencies in the forex market. Spread is known as a difference between the bid and the ask price, which constitutes income of a brokerage company in most cases. It can also be defined as the difference between the sell quotes and the buy quotes in pips. Spread can be represented as spread is equal to ask minus bid. For example, 5 minus 4 will give you 1. 1 is the spread that is charged by the broker. The smaller the spread, the more liquid the currency. The spread is between this red line and this blue line. Right, this is the spread. This minus this will give you the spread. So 1.0614 minus 1.0615 will give you 1. Bid and ask. The bid, ask and spread, all forex quotes are quoted with 2 prices, the bid and ask. In general, the bid is lower than the ask price. Bid and ask. The bid is the price at which your broker is willing to buy the base currency in exchange for the quote currency. This means the bid is the best available price at which you, the trader, can sell to the market, while the ask is the price at which your broker will sell the base currency in exchange for the quote currency. This means the ask price is the best available price at which you can buy from the market.
Lot size. A lot size is the standard transaction size in the forex market that equals 100,000 units of the base currency.
So looking at this, we have lot size, we have units, we have volume, and we have pip. So the standard lot size is 100,000. The mini lot size is 10,000. Micro lot size is 1,000. Then nano lot size is 100. In Forex, you cannot just decide to buy or sell one euro. They normally come in lots. Standard lot is 100,000 units. Mini lot is 10,000 units. Micro lot is 1,000 units. And nano lot is 100 units. So the volume is 1. The volume of this mini lot size is 0.10. The volume of this micro lot size is 0.01. The nano is 0.001. So, and this is how much you make per pip of all this lot size. So you can see in this picture, we have a deposit of $3,000, then we have a profit of $253. But looking at this Euro USD, we have a sale of 10 lot size, which gives us $230. Then we use one lot size here, which is a standard lot size. This one gives us 22. Then we use a mini lot size here, which is 0.1. This one gives us $1.1. Then we use micro lot size here, which gives us 0.05. So looking at this lot size and this profits, you will notice that this particular lot size is smaller than this. Then this one also is smaller than this. And this one also is smaller than this. So this particular lot size, if you multiply it times 10, we give you this. If you multiply this one times 10, we give you this. If you multiply this times 10, we give you this. Then you can see the difference between the lot size and this. The profit here is smaller than this, right? While the profit here is bigger than this, right? So if you look into it, you will know the bigger your lot size, the more money you make. The smaller your lot size, the less money you make. So your lot size is used to determine your profit and your loss in the market.
Leverage. When you use leverage more than 1:1 in the forex market, you are automatically leveraging on your broker's money in lot size. While using leverage, the profit potential is limitless, but loss will never exceed the original capital. It is advisable not to use more than leverage 1:500. Leverage 1:1 means you invest 1,000 and trade with $1,000 in lot size. Leverage 1:10 means you invest 1,000 and you trade with $10,000 in lot size. Note, you will only be allowed to use a bigger lot size for a small account balance when you use leverage more than 1:1. Margin. A forex margin is often represented as a percentage of the full amount of the chosen position. For instance, most forex margin requirements are estimated to be around 2%, 1%, 0.5%, 0.25% based on the margin required by your forex broker. You can calculate the maximum leverage you can use in your account. For example, 100:1 leverage, also known as a 1% margin requirement, means $1,000 of margin is required to open a position size worth $100,000 account. Margin trading makes forex attractive both for big investors and individuals.
Trading session. Trading often focuses on one of the 3 trading periods rather than attempts to trade the market 24 hours per day. This is known as the Forex session system. Those sessions consist of Asian, European, North American session, which are also called Tokyo, London, New York. So you can see in this picture, we have London session. So between 7 to 15 is the London session. Then we have the New York session. Between 12 to 20 is the New York session. We have the Sydney session. Between 21 to 5 is the Sydney session. And we have the Tokyo session, which is between 23 to 7. So between 12 and 15 is the overlap of London and New York session. this is the best time for you to trade, because by this time London is still awake and New York are also awake. So you want to trade around this time. Also, you can see this Sydney between 23 to 5. Both Sydney and Tokyo are awake. So you want to trade around this level. You want to trade here. So types of trading: we have scalping, we have day trading, we have intraday trading, we have swing trading, we have position trading, we have investing or long time trading. So we have types of traders: we have scalpers, we have day traders, we have intraday traders, we have swing traders, we have position traders, we have investors or long time traders. So scalpers, social scalp traders, they hold trades for only seconds or minutes, while day traders hold trades for up to a full day. Swing traders hold trades for multiple days or weeks, while position traders hold trades for several weeks, months or years. So if you're a scalper, you trade using 1 minute time frame, you want to enter the markets and leave the markets after 1 or 2 or 3 or 5 minutes, right? While day traders, those kind of traders trade on like 5 minutes or 15 minute time frame. Intraday traders, those kind of traders will trade for like 1 day, 2 days, 3 days. While swing traders will trade for like a whole week, sometimes 2 weeks, 3 weeks. Position traders will trade for like months, 2 months, 3 months, 4 months, and the likes. While investors or long-time traders will trade for months, years, sometimes 5 years, 6 years. The likes of Warren Buffett, they are investors, right? They invest in stock, they invest in currencies for years. So time frame for different traders: trading style, their time frame, and the holding time. Scalpers hold their trade for like 2 minutes, holding time between 16 to 20 minutes. They enter the market and leave the market. Intraday traders for like 40 minutes to 50 minutes, they hold the market and leave the market, right? They use 5 minute time frame. Also, intraday traders, they also use 15 minute time frame. They hold the trade between 2 hours to 3 hours. Intraday / swing traders, they trade using 1 hour time frame. They hold trade for between 8 to 10 hours. Swing traders, they use 4 hour time frame. They use 32 to 40 hours to hold their trades. Market orders. Instant execution is a type of execution when a trader is placing an order and specifies both volume and price. The order should be processed instantly. So instant execution is when you place a buy and you want the market to open at that particular time, or you place a sell and you want that trade to open at that particular time. Market execution is a type of execution in which the trader places an order and specify only the volume. So we have buy stop. A buy stop instructs a broker to purchase a security when it hits a strike price that is higher than the current price. So a buy stop is always above. So when your prediction is that the market will go up, so sell stop is opposite of buy stop. It is a stop order to sell at a market price after a stop price parameter has been reached. Buy limits. Buy limit is a limit order to buy at a price below the current market price. Will be executed at a price equal to or less than the specified price. So opposite of buy limit is sell limit. So take profit, also known as the target profit. It is an order that you send to your broker, notifying them to close your position or trade when a certain price reaches a specified price level in profit. Stop loss is when you believe the market will go up, but what if the market go against you? So you want to lose a little amount of money. You don't want to lose more than that money. So a stop loss is a function offered by brokers to limit losses in a volatile market moving in a contrary direction to the initial trade. So a trailing stop is a special type of trade order where the stop loss price is not set at a single place absolute dollar amount, but instead is set at a certain percentage or certain dollar amounts below the market price. Advance of Forex trading. These are the lessons under advance of Forex trading. Types of charts. What is candlestick? Types of candlestick. Opening and closing price. So let's get started.
Types of charts.
We have 3 different types of charts. We have the line charts, we have the bar chart, and we have the candlestick chart. This is an example of the three types of charts we have. You can see line chart is a line. This is the olden days chart. So this is the kind of chart they use in the olden days. And also, if you watch CNN, you watch news online or on TV, you will notice they used to represent their charts with this. This is easier for the whole world to understand. So that's why they use this on TV and on blogs. So this is the second example, which is bar charts. And this is the latest of them all, which is the candlestick chart. So on your MT5 or MT4 app, you will see this kind of thing. When you go to the settings, you will see the bar chart, candlestick chart, line chart. So you can decide to set your chart to bar chart or candlestick chart or line charts. I prefer using candlestick chart, and please make sure you go to Play Store or App Store. Download MT4 or MT5 app on your phone so you can have access to see all these things. The MT4 or MT5 app is the app the whole world traders used to trade in the market. They use it to analyze the chart, to know when to buy or when to sell in the market. So make sure you download your MT4 or MT5 app on Play Store or App Store so you will have access and take advantage of the market. So you can see here, this is bar chart. So you can see this is bar chart, this is candlestick chart, and this is line chart. So the candlestick chart is the most popular chart in the world. So 90% of the world traders trade using this candlestick chart. So what is candlestick? A candlestick is a style of financial chart used to describe price movements of a security, derivative, or currency. Candlesticks are used by traders to determine possible price movements based on past patterns. Candlesticks are useful when trading as they show 4 price points, which is the open price, the close of the price, the high, and the low throughout the period of the time the trader specifies. So this is represented by the picture here. So you can see this is the two types of candlestick we have. We have the bullish candlestick and we have the bearish candlestick. So you can see this is the bullish candlestick and this is the bearish candlestick. I think you know what a bull is and you know what a bear is. Those two are animals. When a bull is angry and it's about to attack, let's say a man or any animal, we push the objects up, while a bear we pin the object down. So that's why we call it bullish candlestick. A bullish candlestick is when a price of a particular currency move from a lower point to a higher point, while a bear when a price of a particular currency move from a higher point to a lower point. The bull candlestick, the market open at the low, then closes here. So the low of the market is this point, while the high is this point. So for example, now let's say you are to buy a bag of rice. Let's use bag of rice as an example. The price this morning of that bag of rice is $10. So between the day, the price of that bag of rice went down to like $7. So the low is $7. After that, during the day, people started buying. There is high demand in the market and the market starts moving up. It now gets to a point where the price of that bag of rice gets to like $30. Don't forget the opening price is $10, but now the price is at $30. So before the market closed, it went down to like $25. So the closing price for that day is $25, while the opening price is $10. But don't forget the price also went down to like $7 before going up. It went up to $30. Now it's at $25. So you can see now the market is bullish. Let's assume this is a bull, then it hits an object and push the object up. So from $10, the price of bag of rice for that day closes at $25. So why the next day the price opened at $25? But you know what? We now have a lot of people selling their bags of rice. Why we only have few people that are now buying? Because yesterday the price was $10, but now the price is at $25. So people now started selling. But before that, the price went up back to $30. People now started selling. So there is high supply than demand. So the price now went down to like maybe $7. Then it now closes at $10 for that day. So this is a bullish candlestick, while this is a bearish candlestick. So types of candlestick. Bullish candlestick, also known as bull candle, which is the green candle, or a buy candle. It is formed when a candlestick opens below and closes above which is caused by high demand and low supply in the market. So there is high demand, a lot of people are buying around this level. They now push the market up to this level, but this was the high of that commodity for that day, and this is the low for that day. So this is a bullish candlestick. Why? A bearish candlestick, also known as bear candle, which is represented by a red color, red candle, or a sell candle. It is formed when a candlestick opens above and closes below, which is caused by high supply and low demand in the market. We now have a lot of people selling for that day. We have high supply than demand. People are no more demanding the particular commodity or products. So what will happen? The price will have to fall. It will have to go down. But for the day, this is the high for that day, and this is the low. So this is the opening price, and this is the closing price. So this is a bearish candlestick. You can see we have the bullish and we have the bearish candlestick. So this is an example of how the candlestick chart looks like. So you can see here we have a blue candlestick and a red candlestick. You can decide to change the color on your MT4 or MT5 platform to any color you want. So you can decide to make the bullish candlestick to be green and the bearish candlestick to be red. You can decide to make the bullish candlestick to be black and the bearish candlestick to be pink. It depends on you. You can decide on your own the color you want. So you can see here this bullish candlestick is represented with a blue color. So the market opened, came down to this level, moved up to this level, then closes around this level for that day. Then the next day it opens here, went up to this level, moved down and closes here. The next day it opens, moved up, moved down, then closes here. The next day it opens here, move down, move up, then closes here. The next day it opens here, right, move down, move up, then closes here. So same thing. That is how the markets move. So this is how the markets move every day. Let's assume okay, this is Euro USD. 1 euro is equals 1.00750. So in how many days? 1 2 3 4 5 6 7 8 9 10 11 12 13 14. In 14 days the price of euro to United States dollar moved from this level to this level. So assuming you take a buy around this level, are you getting it? You would have made a lot of money from this level to this level, because we now have more bullish candlestick than bearish candlestick. So the blue is bullish while the red is bearish. So opening and closing price, the time frame can range from 1 minute to 1 month. The key points are opening price, high, low and closing price. The opening price is the first price of an asset in the current period. A high is the highest point of an asset in a particular time frame. A low is the lowest price of an asset in a certain time frame, while a closing price is a final price of an asset in the current period. This figure is most frequently used in analysis and is considered to be of the great importance. Display high, low, open and close price for a specific period. I've already explained this, that this is the opening price of this bullish candlestick and this is the closing price, right? But this is the low for the day, while this is the high for the day. Then the next day, this is the high, this is the low, while this is the open price and this is the closing price. Conclusion:
Forex, also known as FX market, is derived from two words, for and x. In Forex market, one currency is being bought and another is being sold at the same time. Forex is an international currency market with daily deals worth $5 trillion. Forex trading is a professional business with relatively unlimited profit potential and opportunities. However, you have to be aware that you will need knowledge and understanding to make money in the Forex market. Forex requires hard work, discipline, luck, and most importantly, patience and less greed. In Forex market, 20% of people controls 80% of all money in the world. You don't have to be great to start, you just have to start to be great. I remain Idowu Oluwaseyi Paul. See you in the next class.